A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coughlin, Chief Currency Analyst Consultant here for HYCM. Hope everybody is doing really well. Looking forward to getting us shipshape and ready for the FOMC meeting this afternoon, later on in the evening here in the UK, and the Bank of England meeting tomorrow. So I hope everybody's doing well. Please, I'm just gonna, there we go. I think that was my internet quality was impacted there. I hope you can all hear me and see me okay. If you could just let me know that I'm coming through okay in terms of sound and screen, that would be helpful. Really looking forward to this session. Got a lot of opportunities coming up. So I'm assuming that you can hear me and see me okay. Someone could just drop a line in the Q&A box or the chat box. That would be great, so I know that I'm coming through okay. Just while folks are doing that, yeah, thanks, Johan. That's super. Thank you. Always good to get reassurance that you can be heard, particularly with these software. Sometimes they don't always operate. Okay, just a quick disclaimer. Don't forget any entries, exits, currency pairs, commodities, indices, stocks we're looking at. Most of this is done from an educational perspective. So the idea is that you look over my shoulder, someone with a professional trading exposure, and you see how I go about making trading decisions as a professional analyst, and that will help you make better decisions. That's the whole philosophy behind this. Now, in today's workshop, we're going to be looking for how to trade the Federal Reserve meeting and the Bank of England decision. So without further ado, I'm going to go over to my other screen, and for those of you who are unaware, Financial Source is one of our partners here at HYCM, and I work as an analyst for Financial Source as well. And so I'm just going to be using this resource as we outline what's happening today, as I usually do. Now, the key thing to look for as we go through markets is this. Number one, equity markets are under pressure, and they're under pressure for two reasons. One, there's sort of Omicron variant jitters, with the World Health Organization warning against complacency by nations to do with the Omicron variant. The World Health Organization are wanting to avoid governments just relying on vaccine efficiency, and also to stress other measures like social distancing, hand washing, good hygiene, ventilation, etc., etc. But having said that, the general news has been quite good for Omicron this week, with Pfizer's and BioNTech announcing that 2 doses of Pfizer's vaccine does actually give 70% protection and against hospitalization, and 33% protection against infection. So that's broadly good. But markets are selling off at the moment on sort of general jitters, because if Omicron is really transmissible, you can still end up causing a lot of harm to economies on shutdowns and lockdowns. But there's also a bit of worry that the Federal Reserve may be about to act too quickly, and that the Fed is going to be raising interest rates too quickly. Now, going back to 2018, we had a scenario where the Federal Reserve projected a whole line of rate hikes just as growth was slowing down, and that resulted in some sudden downside. So we have to watch out that we don't get the similar with the Federal Reserve meeting tonight, that we don't see the Fed aggressively price in inflation expectations, aggressively price in rate hikes, and that results in a sharp sell-off in stocks, particularly with the NASDAQ being hit. Now, I was speaking to a US-based media organization called benzinger.com, and I have popped it up on my Twitter feed. So just have a little look. Where is it? Let's just see. I did put up the report. Yeah, there we go. I was chatting on the CBRT, Central Bank Reserve of Turkey, their move, and inflation generally. And it was amazing because this US organization was talking about inflation for about 30 minutes just on inflation. So that was really important. It did tell me something actually. And what it told me is that inflation has become very politicized in the US. And I was speaking to a few other guys from the US earlier today, in an earlier webinar I do, and they were saying, yeah, it's always on the news. Everyone's talking about inflation. So that means it's very politicized. Now, when things are politicized, they can go badly wrong. And in terms of monetary policy. So if you take a look at the Central Bank of Turkey, when you've got President Erdogan, who is a politician, and he has very strong opinions on central bank policy, and he thinks that high inflation, high interest rates, he thinks cause high inflation, which is a very unorthodox view. The received wisdom and the general way markets actually operate is that when inflation is high, by raising interest rates, it lowers inflation. Now, President Erdogan thinks they should be cutting interest rates, which is really, look, there's 20% inflation in Turkey. Interest rates are currently at 15%. I think they need to raise by about 500 to 1,000 basis points to get things back under even keel. So it's just insane what's happening here with the Turkish lira. And this serves to show you, look, when monetary policy becomes political, things go wrong. Now, the Fed are now meeting tonight, and inflation has become political. So there is a definite risk that the Fed are seen to come, they have to be seen to be responding to inflation. And if they come in too heavy and too hard, then we would really expect that to be a big vulnerability. Now, at the moment, the market's expecting 2 rate hikes from the Fed Fund futures. So 2 hikes expected for next year. Now, if the Fed comes in very hawkish, then we could really see some significant dollar appreciation. And the one market that I'm really focused on is gold. Okay, now if you look here, you can see we've got strength in the dollar, we've got strength in real yields. Now, when these two are both moving together, we see moves in gold. So you can see here when we had real yields rising, dollar rising, gold fell sharply. Now, the dollar will rise if the Fed's very hawkish. Real yields will rise if the Fed's hawkish, because inflation expectations will lower because interest rates are coming to handle them. But interest rate expectations will rise because the Fed are signaling faster interest rate hikes. So that means real yields will push higher. So if the Fed are more hawkish, look for gold downside. That's a great opportunity that I'm seeing if, and I stress if, the Fed are more hawkish. Now, if you look at this from a technical perspective, you can see here you've got a hidden bearish divergence on the daily chart. You see that price is making a lower low, the indicator is making a higher high. That technically is sound, and technically would signal a move like down to that 1720 region. But we're not just focusing on the technicals, we want the fundamentals and the technicals to come together. So if the Fed are very hawkish, we can look and expect to move back down to that 1720, 1730 region. But if the Fed are much more dovish, then look, we've got this, inside bar pattern. We could easily see a false break for the inside pattern if the Fed signals something hawkish, but are actually more dovish. Then we could see a false break of that inside bar, which would signal higher prices back up towards that 1800 and then up to 1860. So depending on what the Fed do is going to be crucial. I think the gold market is one of the better expressions to look at today, just because the technicals are so solid on it. And if you look at the seasonals for gold are really red hot. If you look from 22nd December to 18th of Feb, gold's risen 13 years out of 15. Now, a lot of that is on physical demand for the Chinese Lunar New Year. Whether that will be taking place to the same extent as as normal still remains to be seen. And you can see last year the trend was bucked, and that was obviously COVID-19 restrictions making celebrations much harder. But the bottom line is there's a seasonal tailwind for gold, and if we have a dovish Fed, then mark this, and it could be an excellent opportunity for gold upside. Now, let's just, yes. So what we want to do is look at the daily risk event outlook for today. Now, the daily risk event outlook is all to do with the speed of the taper. So this is what to look for, and do take a screenshot of this. You can use it. Okay. Now, if the pace is doubled, and that's what's expected, there is a risk of a buy the rumor, sell the fact response today, because the Fed are expected to taper more quickly. So if everything is just totally as expected, then don't be surprised if we suddenly see a reversal and we see like the dollar selling off. But a hawkish reaction would be if they double the pace and then they try to distance the language of the end of tapering from the start of hikes. In other words, if they sort of say, well, you know, if they're as explicit as this, it'll be obvious. If they say something like, you know, we could always raise interest rates before the end of tapering. If they said something like that, they'll be very hawkish, which could mean we could get a rate hike as early as, you know, the first quarter of next year, even before tapering has ended. And if they say, yeah, we got it wrong in inflation, we've got more upside risk for inflation, and we see inflation rising higher, if they have their core PCE projections raising higher, then expect more upside in the dollar. And if the median Fed dot plot shows 3 hikes expected for 2022, then we'd expect upside in the dollar, downside in gold, downside in equities. That's the thing to look at. So a hawkish Fed would show downside in gold. Now be careful. Be careful, because the outcome we have to look out for, and I remember that chart I showed you with President Erdogan, and you know, when politicians mess around in central bank policy, central bankers don't want politicians messing around in monetary policy because it's not good for them, and it's not good for the economy as a general rule. So they might tip their hat, as it were, to the political pressure. And they may do something like a hawkish indeed, but dovish in word response. It's a response that we've seen before. Central banks can do. They can, you know, the Fed can double the speed of tapering. They could express certain views on inflation, but then they could really stress, you know, Omicron variant risk, and we not, you know, yeah, maybe inflation will still be lower longer term, and you know, we don't want to rush hikes at all. You know, they can really talk back the hawkish action. So watch out for that. We could get some very, very choppy action tonight, more so than usual, because there's political pressure in the mix. Now, the dovish outcome would be if they double tapering pace, or if they don't double the pace of tapering. If they keep tapering the same, that would be ultra dovish, fantastic for gold. That would be a lot of dollar downside. But if they still double the taper pace, which is largely expected, but they give a stern signal that a faster taper doesn't automatically mean higher rates, they stick to their previous desire that they want to see employment back up to pre-COVID-19 levels. They want to see maximum employment, you know, still some way to go, yada, yada, yada. And if they state that even though they got inflation wrong, they still think inflation is moving lower medium term, which is kind of the more received wisdom across the world. So Reserve Bank of Australia, inflation is transitory. European Central Bank, inflation is transitory. Bank of England, inflation is transitory. You know, that transitory inflation story makes sense because if you think about it, all that pent up savings during lockdowns, individuals, consumers, companies even haven't been able to spend it on services like restaurants, hotels, holidays, leisure. They've all been restricted due to COVID-19 restrictions limiting social interaction, but goods have been purchasable. So all that demand goes into goods, and goods can't be supplied at sufficient speed because the supply chains are hindered by COVID-19 illnesses and restrictions, and that demand just means prices surge. So a lot of the supply chain issue has driven the inflation in the near term. Now, what central banks have to be careful of is that inflation doesn't become systemic. Now, this is how it works. Like in Turkey, if you think about it, imagine we were living in Turkey now, and you know that inflation is 20%, and you've got to buy a computer. Will you buy the computer this month or next month? You will definitely buy it this month. Why? Because if you wait a month, you know it will cost you more. So there reaches a point where the fear of inflation drives inflation. So inflation itself causes more inflation because people are afraid and they don't put off purchases. They bring purchases forward, which drives inflation even further. And also, the other major concern is for wages, because there's a lot of people who are struggling to get back to work or unwilling to go back to work because they've been, heavily supported by governments, etc., etc. So in the UK, I was listening to one restaurant owner saying, I've got to up all my wages for my staff, and because I've had to up all my wages for my staff to get them working again, I've then also had to increase my prices. So if wages keep rising, that's what happened to the Bank of England this week. Yeah. The Bank of England saw wages rise, inflation's risen, so expectations of the Bank of England will have to raise rates. We'll come to that in a minute. It's still 50-50 whether they will or not, but the short-term expectations suddenly risen for those reasons. And central banks won't want to see that. They won't want to see wages moving higher like that. It'll unnerve them. So that's the pressures on. And that's what's going. So they're the hawkish, that's the dovish outlook. We then have Canadian CPI. The best opportunity here will if it's low. Okay, the last Bank of Canada meeting, and do always look at my blog. I keep up to date, generally speaking, on almost all central banks. You can see here I covered the last Omicron risk and floods wear on CAD. I looked at the Bank of England yesterday. So just a reminder, they basically that's basically what they did. They highlighted the Omicron risk and the floods in British Columbia that was weighing on the risk. Okay, and that's what was dragging down the CAD as of late. So if inflation data is low, if it's below the minimum expectations, and if we just take a look at the expectations, you can see that they're looking inflation to come in like, if it's below 4.3% for the year on year and the month on month is below minus 0.3%, then expect upside in something like the Aussie CAD. Now the Aussie CAD would be good because the Reserve Bank of Australia kind of like a little bit more optimistic in that they're not dovish, and they've been really uber bearish for some time. Their last rate meeting, they're much more neutral, and you can just again go to my central bank watch. Their kind of neutrality, as I put past peak bearishness now. So, I was looking like strong Aussie labour data and fading Omicron fears could be a catalyst for Aussie yen gains. So looking at that, and the RBA watcher McCran is sort of saying, there could be, I haven't put the link in there, but basically saying there could be an interest rate hike as early as next year, right? So very, very hawkish in the near term environment of a very dovish CAD. So if CAD is a big miss, then more Aussie CAD upside is in play. Look out for that. It's not, just to be clear, it's not that the Reserve Bank of Australia were hawkish. It's just that they passed that peak bearishness and now they're starting to look for growth, and they're expecting, Delta COVID gains to, falls rather to reverse the start of next year. They're on the way up, is what I'm trying to say. GDP data for New Zealand, important. Like Governor Orr had a testimony yesterday. He didn't say much, but he did say a couple of things. One, that it's still relevant to remove a stimulus, and he talked about the New Zealand housing market being overdone, liable for a correction. That's code for watch out, interest rate hikes are coming. So, don't take out, a bigger mortgage than you can, and watch out housing market. So still, the RBNZ, they're projected to raise interest rates to 2.6% by the end of 2023, according to their last interest rate meeting. Again, check out my blog, I do cover that. And the key aspect here with this GDP is that the New Zealand dollar has been heavily sold off on risk. With all the negative risk sentiment surrounding Omicron variant, maybe the Fed hiking too quickly, that's hit the New Zealand dollar. New Zealand dollar is starting to look, if vulnerable to a turnaround, and a really good GDP data above maximum expectations could be the catalyst. So that's what we're looking for, okay? So GDP year on year, the high expectations minus 0.4, anything better than that would be supportive. The quarter on quarter, the minus 3%, anything better than minus 3% would be good, okay? So, and the average 4.9%, if we get that pushing higher again, that would be good. Aussie Jobs, important. RBA's big focus is jobs. They really, really want to see jobs moving. And if jobs start moving higher, that could support Aussie CAD upside further. But don't forget, bearing in mind the CPI data, the best opportunity for Canadian CPI is a miss. If we get like a high reading, that's one, inflation is manageable in Canada. Two, the market will look through one high reading. It won't matter. And we've got retail sales next week and GDP next week, so that'll just fade away. But a miss won't. Now, with the Aussie Jobs, again, big focus of the RBA, and we want to see if it's above market's maximum expectation, that's in line with that recent Australian dollar strength. So just so you can look here, if we look at the Aussie dollar, since the last RBA meeting, what about early December, wasn't it? It was yeah, so what was it, around you can see from the RBA meeting, see how the Australian dollar is outperforming the other currencies. You see that? All right, that's what's going on there. It's past peak bearishness, and so that means if we get really good jobs data later out, then that should be supportive for the Aussie. And look for the Aussie against the CAD. So anything above 300,000, unemployment, if it's sub 4.7%, and participation rate is high number. So the participation rate is basically how many people are available for work in the economy, okay? What that means, the higher the number, the better. So in this instance, you'll see a high number. Unemployment, the lower the number, the better. Because obviously that means the less people that are unemployed, the better it is, right? And the employment, that's the headline. The best component of that headline is full-time employment. So what we want to see is full-time employment high, 300,000 jobs, most of that full-time, unemployment low, and participation rate high. Now that would be good for Aussie CAD, okay? If it's a big miss, then look for Aussie New Zealand dollar downside, particularly if the CPI data is very good. Sorry, particularly the GDP data is good for New Zealand. All right, folks, I hope that's all making sense. Now, we also have, as if that wasn't enough for us, we also have the Bank of England meeting tomorrow at 12, right? Now, SONIA futures have been dropping and dropping and dropping recently because we've had Omicron fears, we've had more restrictions, we've just had vaccine passports voted through in the UK, we've got Boris Johnson struggling with political power at the moment. Will he still be able to keep control of the Conservative Party? There was rumours or an alleged party happening in UK Parliament while the rest of the country was in lockdown. So politically, things are very difficult. COVID-19 restrictions, work from home orders have come back into place where it's possible. If you want to attend a big venue, you need to show your vaccine passport. So tricky. And all of that's been weighing on Bank of England expectations. But the Bank of England have got their own set of problems. They've got Omicron uncertainty, but now they've got rising wages and rising inflation. Now the SONIA futures are pricing around 50-50 coin flip chance of a rate hike coming tomorrow. Now, the fact that the expectations are so muted gives opportunity. I think one of the best opportunities would be in like seeing euro pound downside, something like that, if we got a hike. So if the central bank hiked, look for euro pound downside, and I'll show you a decent way to trade that. If you just look here at euro pound, just imagine that this is like, imagine this is like, 10 seconds before the release. Because it's 50-50, investors aren't really sure what to expect. So that means that if you put a sell and stop about 0.8480, right? So 8494, go down about 15 points on the euro pound, put 8480. Now, when the interest rate breaks, if there's a hike, the pound will appreciate you just get taken in. Okay, you get a bit of slippage because markets are moving fast, but because it's a hike and unexpected, then you'll keep going into the trade, right? And you can take 20, 30, 35 points profit off the bat. So look at that. Now, if they don't hike, we probably won't get a reaction because the expectations are that they probably won't hike, but if they do, then we'd expect sudden upside of the pound, we also expect upside in the pound US dollar pair. So I would favour, if they do hike, you've got the ECB also meeting like 45 minutes later. So bear that in mind, and they should take a more dovish stance. Okay, so euro pound, if you've never sold on stock like that before, you would want to try it. And try it like, with a very, 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 very tiny amount of risk. But that's what I would do in case you get the outside chance of a Bank of England interest rate hike. All right. Okay, folks. I mean, we've got the Swiss National Bank as well. So just look, Swiss National Bank. Just see breaking above that trend line and stay above that. That does look potentially bullish for the euro Swiss franc. The Swiss National Bank are meeting tomorrow as well. And if they kind of signal any worries about the strength in the Swiss franc, we could easily see the euro Swiss franc recover tomorrow. But we also have the ECB, so watch out for that. So what you want to look for the Swiss National Bank is if they say anything like, the Swiss franc is highly valued and we may be intervening more, or we're not going to tolerate the euro Swiss franc going down much further, or we're going to be more actively engaging. Anything that indicates they're more concerned about this Swiss franc strength. The Swiss hate a strong Swiss franc because it really hurts their export economy. Because when the Swiss franc is strong, so a strong Swiss franc, it makes imports cheaper, yeah, but it makes their exports more expensive. So because they have a large export economy, you think of watches, jewelry, etc., etc. It makes them all less competitive. So they don't want to see more a downside to the Swiss National Bank. Notice last week we did have the first bullish week in about since September we had last week. So wouldn't be surprised to see the SNB trying to make a base out of this. They've got a meeting to. Remember, they're scared. The Swiss National Bank, not scared is the wrong word, but they remember they tried to defend the level 1.20 back in 2015. They managed it for like 3 years, whatever, and then they couldn't. So but we are heading into heavy support here. But the risk-off tones isn't helping this because the strength of the Swiss franc is in line with the broad fundamentals. Folks, I hope that helps. Going to go over to the questions. With this highly contagious but less lethal variant, that's well put, Royden, do we see a hawk in the Feds or a dovish move? Royden, what I'm expecting, and then, look, this is just my opinion, Royden, so in one sense, it's not worth anything because we want to trade the facts, not opinions. But my opinion is we'll see a hawkish indeed, dovish in word action. That's what I think we'll see. But it remains to be seen. Just notice, I spent nearly half an hour speaking to a news media agency, Benzinger.com, midweek on inflation, nearly half an hour. So that tells you how politicized it is. There were questions left, right, and center. Okay. Right, been a lovely year. Hope everybody has had a good year. I wish you all a very Merry Christmas, and I am scheduled to be back here in the new year. I will be away taking a well needed rest, and we'll be back, God willing, fresh and ready for a new year. So I hope you all have a very good break. Yeah, you're very welcome, Royden, and I will be scheduled to be back here with more insight next. Make sure you follow me on Twitter. Don't forget, follow my blogs, as I will be updating as I can. It will go a little bit quiet. I will have a few educational pieces coming out that I'll write in advance. And also don't forget my Twitter handle at Giles Coughlin CCA. And thank you all very much for your time. Thanks everyone, and have a great break. Thank you. Goodbye.